All right, welcome. Good afternoon, everyone. My name is Tony Zhang. I am the chief strategist here at Options Play, and today we're going to be talking about how to trade earnings like a pro. Earnings seasons is certainly an exciting time to trade. There is a lot of risk when it comes to trading earnings, so that's why we like to use options when we're trading or taking bullish or bearish bets during earnings seasons, because options allow us to um, play earnings with limited risk. So that's really what we're here to talk about: is how can we use options to still take advantage of these binary moves, which usually involve a lot of volatility, but do so that we manage our risk around that and limit our risk when we take these bets during earnings. Today, what I'll do is I'll spend about 10 to 15 minutes talking about some of the nuances about trading earnings, making sure you understand exactly what impacts option pricing around earnings, because it's really important to understand that before you go ahead and place a trade. So just a quick um, snapshot of who is in the room. For those of you that are new to options, please type new into the chat window. And for those of you that have some experience trading options, or maybe you've traded earnings before, type in no. So I just want to get an idea as far as who's in the room. Okay, so it looks like a lot of you are relatively new to trading options here. So today, we'll try to keep this as basic as possible. And for those of you that have traded before, what we really want to do is show you how you can quickly use our tool to identify trading setups that allow you to take bullish or bearish bets on earnings with limited risk. So I'll spend about 10 to 15 minutes using the slides, but what I really want to spend most of my time here is actually using the platform to show you real life examples using our platform, so that after we're done with this webinar, you'll have the confidence to be able to use this tool and start evaluating trades yourself for trading earnings or any other strategy for that matter. This webinar is recorded, so for those of you that are newer to options trading, you definitely want to take some time afterwards to view the recording, review kind of what we're talking about so that you can follow along, and then utilize the platform with what you've learned here today. So what I'll go over here today is I'll talk a little bit about the earnings season itself. I'll talk a little bit about how last season played out and what our expectations are for the Q1 results that are reporting soon. The most important piece when it comes to trading options is actually understanding how different things in the market affect option prices. So what I'll do is I'll spend a little bit of time talking about the option Greeks, because that is what helps you understand how the option prices are impacted based on different things that go on in the underlying market. What I'll talk a little bit about is how earnings pricing will change around earnings. Extremely important to understand if you want to take advantage of these large binary events that generally give you large moves in one direction or another. And then lastly, we're going to spend most of our time going through some live examples to show you guys how to use options play with the P&L simulation that we provide you with, so that you can quickly identify the right setups to trade when you're trading options. Regardless of whether you're trading earnings or just starting out and trading calls and puts, you can use our P&L simulator that will give you quick snapshot data so that you can identify which strategy is best suited for you. So let's go ahead and just get started here. Just talking a little bit about what our expectations for the Q1 results that are being reported starting this week. So talking a little bit about what happened last earnings season, that was one of the strongest earnings seasons we've had on the calendar. We had above average beats on both earnings per share as well as sales, so both top and bottom line. We had some pretty strong numbers across the board. These were some of the strongest sales numbers in the last 5 years. That's really important to understand, because growth since the 2008 financial crisis, most of that growth in terms of earnings were bottom line, meaning meaning companies weren't necessarily growing a lot in sales, but they were doing a lot in terms of cutting costs. They were buying back shares. These were the types of growth that we were typically seeing from these companies. But over the last last year or year and a half was really when we started to see sales also grow as well. So it's really important for us to see sales growth in order for truly organic growth in the market. So that was an interesting thing to continuously see in the markets. However, the one thing that we did see last quarter is that the overcrowded stocks were the ones that miss, and they were the ones that got hit the hardest when it came to results. So stocks that beat their earnings, we didn't see a huge strong growth on those companies when they did beat earnings. And for the ones that missed their earnings, those were the ones that we saw the largest moves to the downside. So, and we expect that theme to happen or to play out again this season as well, is the stocks that beat may not outperform too much, but the stocks that miss will likely have large moves to the downside. So that is another thing we kind of expect to see this earnings season. So talking a little bit about what our expectations next for this upcoming quarter is forecasts currently show really strong sales growth. So we're still expecting that sales growth that we saw last quarter to continue. Early reports and the macro indicators currently points to what we effectively believe is that many companies will beat their earnings numbers, both top line and bottom line. However, there are some concerns in terms of what deals NAFTA will have an impact on the bottom line in terms of investment, in terms of sales. NAFTA is one thing that we are kind of unsure of and is certainly on the top of a lot of companies' minds at this point. So that is one thing to keep an eye out for as you look at companies' earnings for when they report their Q1 earnings as to what their expectations or what their forecasts are with NAFTA. Now that we have an understanding as to kind of what our expectations are for earnings season, and we know that during earnings season, when a company beats earnings, that's when they're most likely to have a large jump higher in stock price. And when a company misses their earnings, that's when they have the largest shock or the largest decrease in stock prices. So it's really important to understand how these things affect an option pricing during our process to determine whether or not we want to trade an option during earnings. So there's three things that's really important to understand and keep tabs of when we're trading options is three things. And these are the three most important factors that affect your option pricing. Number one is delta. This is the number one Greek that you need to pay attention to. And what delta tells you is the change of the price of the option with respect to the change of the stock price of the stock. So if the stock goes up by $1, how much does your option price change? If the stock goes down by $1, how much does your option price change? Really important, because this is really where we expect the largest move to happen during earnings season. We expect the stock price to move very, very quickly overnight, effectively, based on whether a stock beats or misses their earnings calls. So delta tells us how much we can expect that stock option price to move based on that stock move. So when you see a option with a delta of 50, that's telling you that that the option price will move 50 cents for every dollar that the stock moves. Now, this is just for illustrative purposes, meaning you don't have to memorize this. You don't have to know how to calculate any of this, simply because Options Play does all that work for you. And I'll show you how we do that, because our P&L simulator will actually show you exactly what your expected profit or loss is. So you don't have to know what these formulas are, and you don't have to know how to calculate them by hand. We will do that work for you. It's just important to understand conceptually what these things mean. Vega, which is the second most important thing to keep an understanding for, is the change of the price of the option with respect to the change in the volatility or the implied volatility of the option. So Vega is something that tells us what the option implies the stock move will be. So if you're seeing a Vega of 0.25, that means that you expect that the option will change 25 cents for every 1% in implied volatility that changes. okay? So this is something to understand because volatility changes a lot around earnings. So right after earnings, we typically see a very large decrease in volatility because right before earnings, there's a lot of uncertainty. We don't know where earnings will be, so volatility is very high. And once the earnings report comes out, that uncertainty goes away, so volatility collapses or volatility comes down right after earnings because we have a lot more certainty as to what's going to happen with the future of the company. So that's really why it's really important to understand Vega, because there is a large change in volatility around earnings. So it's really important to understand how that impacts your option pricing. Lastly, there's Theta. Theta tells you how much the price change in the price of the option with respect to time. Because time continues to march on, you can't do anything about that. And when you're long an option, you're actually losing money every single day you hold on to that option. And Theta simply tells you how much you're losing for every day you hold on to the trade. So a Theta of 0.10 means that the option will lose 10 cents for each day that passes for the trade. So it's really important to understand if you're going to hang on to this trade for 3 weeks because earnings are 3 weeks away, you want to know how much money you're going to lose to time value. And that's what Theta tells you. So these are the 3 most important things to understand around earnings because number 1, you get a large shock in stock price. So you want to know delta. You get a large collapse in volatility. So you want to understand Vega. And then it does take time between now and expiration or now and the earnings date. So you want to know how much money you will expect to lose to time value between now and then. So these are the 3 most important Greeks to understand when you're trading earnings. The only thing is you don't have to memorize these things. You don't have to calculate it. We do the calculations for you. You just have to understand it conceptually how these things affect your option pricing. So when it comes to earnings, again, earnings is not an easy thing to trade. It's actually quite risky. I call it 1 step forward, 2 steps back. And the reason for this is because when you're trading earnings, the large stock move based on the stock beating or missing is the factor that's working in your favor. Meaning if you think a stock's going to beat and it actually beats on earnings and moves significantly higher, that's going to work in your favor because that's a delta working in your favor. However, whenever you have this one thing working in your favor, there's always 2 things working against you. So volatility, we talked about volatility always coming down right after earnings. So because of that, you're actually going to lose some value in the option based on that loss in volatility. So that thing will always work against you. And this is something that there's nothing we can do about. Volatility will always come down after earnings because uncertainty is removed and that volatility decreases. And that lowers the cost or lowers the price of the option. The other thing is time decay or time value is always working against you. Because you can't stop time from moving forward, time decay is always going to erode at the value of your option that you've purchased. So these 2 things are always working against you. So what that means is that in order to profit trading options during earnings, you must have a very large stock move that's large enough that overcomes the money that you're going to lose to the volatility crush and the money you're going to lose to time decay. Okay, so what I've put down here below is 4 different scenarios. And out of the 4, only one of them really is the profitable one when you're trading earnings. And that's why trading earnings is difficult to do. Trading earnings, for a lot of people, sounds like it's a cool thing to do because you can make a lot of money very quickly, just in a day or 2. However, I do want to make sure that people understand that that only happens in certain scenarios. And it's important to understand what those scenarios are before you start placing your real money on the line. So in order to profit trading earnings, not only do you have to get the direction right, it has to be a large enough move. Meaning the move has to be large enough to overcome the money that you're losing to volatility and the money that you're losing to time decay. So that's really why you not only have to call the right direction, so you have to essentially say that I think that the stock is going to beat on earnings or I think the stock's going to miss on earnings. You have to call that correctly, but it also has to beat or miss by a large enough amount that the stock moves a significant amount. So there is the possibility that you call the right direction, but it's not a large enough move, meaning the move is too small in order for you to profit from that. So these are a scenario where you can actually be right on the trade. You might be right that the stock's going to beat on earnings, but maybe it only beats by very little and the stock doesn't move very much. And a lot of times when that happens, you actually still lose money on the trade because the move was not large enough to overcome the money that you've lost on the volatility crash and the time that you've lost to time decay. Lastly, if you call the wrong direction, it really doesn't matter whether the move's large or small. This is usually, you're going to lose money on that trade pretty much guaranteed. So you have to not only call the right direction, the direction actually has to also be large enough in order for you to be profitable. So let's talk about what strategies can you use to deploy using options that provide you with limited risk in order to trade these option strategies around earnings. So the first two strategies, so for those of you that are relatively new to options, these are the two strategies that you want to start off with, okay? So if you're bullish or if you think stock's going to beat earnings, you would buy a long call. And if you're bearish or if you think the stock's going to miss, you would buy a put option. These two strategies give you unlimited profit potential, so that if the stock goes significantly higher or significantly lower, you continue to profit as long as the stock continues to go in that direction. You typically use this strategy when you expect a big move in the underlying stock. So if you expect a large beat or a large miss, these are good strategies to use. They do generally put a larger amount of money at risk, okay? The other two strategies that you can use when you're trading earnings is you can either buy a long call vertical if you're bullish, or a long put vertical if you're bearish. A long call vertical, for those of you that are new, is a more complex multi-leg strategy. It requires buying one call and selling a higher call. And for those of you that are buying put verticals, it's essentially buying one put and selling a lower put. And this is used when you have a limited profit potential. So meaning when you enter the trade, you'll know exactly what your expected profit potential is, or what your maximum profit potential is, and that will determine the most amount of money you can make regardless of where the stock goes. And this is a strategy that you would use if you expect a modest or slower move in the underlying stock. So if you don't think the stock's going to make a huge beat or a huge miss, or if you think that the stock after it beats is going to grind higher, meaning it's not going to make a quick move higher, and you would use a vertical as opposed to just a call or a put. And lastly, this strategy does put a smaller amount of money at risk. So you're not risking as much money as if you're just buying a call or a put up here, okay? So I'll go over examples of both of these strategies, and the great thing about options plays is it allows me to put the two side by side so you can actually see the two performing next to each other and decide for yourself which strategy is suitable for you. You don't have to decide right now. And that's really the power of options play, is because normally if you're using an option chain to select which options to trade, you have to first select the strategy before you even see the prices of those strategies, before you even see how those strategies perform. How are you supposed to choose whether you want to go for a call or a call vertical if you have no idea which strikes you want or how they'll perform? So that's really why options play allows you to put the two side by side so that you don't have to decide first. You can put the two side by side first, then decide which one's best for you. So the last thing I want to point out is that when you're trading earnings, you want to pick an expiration that has at least 1 to 2 weeks out after earnings for your expiration dates. You don't want to pick an expiration date that's 2 days after earnings because you're not going to give yourself enough room. A lot of times the move that happens may take 3, 4, 5 days to materialize. A lot of times the stock may beat earnings and then still spend the next week or two continuously moving higher. So you want to give yourself a little bit of room after the earnings date when you're trading options or when you're picking your expiration dates. So let's actually go through some real examples using options play. So for those of you that are new to options play, welcome. I really hope that this platform, it helps change you as an options trader. If you're a beginner, I hope this platform inspires you to start looking at some option strategies that maybe you weren't comfortable looking at before, or didn't know which strategies to choose or which expirations to choose, this platform makes it a lot easier to help you explore, analyze, and hopefully eventually trade the option strategies. And for those of you that have experience trading options, I really hope that this platform helps make your life a lot easier. It helps drive down the amount of time it takes to research the strategy down to just a few seconds as opposed to a few minutes. And it presents multiple ideas to you based on any underlying view you have for any stock or ETF, so that you can start exploring different strategies, putting them side by side, and giving you the tools so that you can definitively say, here's the strategy that I want to trade. It's really important that you understand your risk and your potential reward before you get into a trade. And that's really what this platform provides you with the tools on how to do that. So what I'm going to do is I'm going to go through some examples here today. I want to point out that all the examples here that I'm giving you today are not a solicitation to trade these individual securities. I don't have a view on any of these securities. I will take, bullish or bearish views on all of these for illustrative purposes on this webinar today. But keep in mind, this is not in any way, shape, or form a recommendation to trade any of these securities. I just have a few different stocks that are reporting earnings in the next few weeks, and I'm just pulling these out, and I'll try to go through some bullish and bearish examples to show you how to go about evaluating these strategies, how to look at them so that you can decide which one you want to trade during earnings. So let's see, ECA is a stock that reports earnings here, as you can see at the bottom of your screen, on May 2nd. This panel here in the middle is our security analysis panel. This provides you with snapshot data so that you can quickly see what's currently going on with the stock, what the 1 month and 6 month trend is doing, the technical score, which gives you a relative strength, quantifiable way to determine relative strength. So you can see if this is a strong stock that's outperforming the markets, or if this is a weak stock that's currently underperforming the markets on a score of 1 to 10. And then the trading and income tab here on the right presents you strategies. So for example, if you click on I'm bearish, it will present you 3 bearish strategies for this stock. So you can short the stock, you can buy a put, you can buy a put vertical. If you're bullish on the stock, it'll show you 3 bullish strategies that you can take. You can buy the shares, you can buy a call, or you can buy this call vertical. Now, notice how we don't ask you to pick a strategy, an expiration date, a strike price. It provides you with starting points for all 3. This is designed especially for you as a beginner, so that you don't have to pick these things that you may not know how to pick. So it presents ideas to you so that you can have a better starting point, a better place to start exploring these strategies and seeing, hey, what's available, what are some popular strategies that people may trade. And for those of you that are currently trading options, this is just designed to save you time, because you don't have to pull up a chain every single time to pick a 45-day at the money call option. It always defaults to that here in the middle for you. And then you can always modify this if you want, and I'll show you that in 1 second. But really, this is designed so that you can quickly, instantly look at some strategies for any stock that you type in. So let's look at ECA right now. This is a stock, it's a fairly neutral stock. It's not really outperforming or underperforming the overall market. The 1 month and 6 month trends are bearish, so maybe you might have a bearish view on this particular trade. So let's click on I'm bearish. It presents me 3 strategies. Here's the put strategy. This is the simple strategy that has a little bit more risk but has unlimited profit potential. And here's that put vertical that has a little less risk with limited profit potential. So let's see how these 2 strategies perform side by side. And what I'm going to use is the P&L simulator here at the bottom, help you guys determine which strategy might be suitable for you if you have, let's say, a bearish view on this stock going into earnings. So as I said, this stock reports earnings on May 2nd. So that's really where we can use our P&L simulator to see where do I think the stock's going to go by May 2nd or a few days after May 2nd, and see how these strategies perform. So let's zoom out a little here. So this stock here, as you can see, has been hovering between this 13 and 15 level for about a few months now. sitting right above the support level. So let's say I think the stock may miss on earnings. It might break below this 13 level and maybe go down to this 12 or 11.50 level. So let's say I think it's going to go down to $12. I can put it so that, and we know it reports earnings on May 2nd. So let's say a few days after, on May 4th. And remember, I said volatility always comes down after earnings. So let's say volatility is currently at 40%, the implied volatility is 40%, so a lot of uncertainty right now. Let's say that comes down to a little bit, to about 27%. Again, there's no exact science to tell you exactly what this volatility will come down by. This is something we can look at some historical charts for to get some guidance for, but generally speaking, we want to decrease it by at least 10% right after earnings, as a general rule of thumb. So like I said, you don't have to remember how to calculate delta, which is the price of the stock compared to the price of the option. You don't have to remember how to calculate theta. You don't have to remember how to calculate Vega, because we do all the calculations for you. You just have to type in where you think the stock's going to go, when you think it's going to happen, and what volatility will do, and it will calculate for you the expected return. So as you can see, if you had shorted the stock, you make a 16% return. If you bought this put, which cost $112 a contract, you make 166% return. This is really why trading options during earnings is usually quite attractive, because you typically can see some very large returns in a short period of time. This is talking about May 4th, so a little under a month. We're talking about 166% return. But as you can see, this put vertical here, 170% return. So this is where you can make the decision very quickly which strategy is best suited for you based on where you think the stock's going to go. So some of you may not be as bearish. Maybe you think that it's only going to go down to 12.50. So as you can see, if the stock goes down to 12.50, you still get 122% return on the put versus 138% return here on the put vertical. So this allows you to quickly compare multiple strategies and see which one's best suited for you. As you can see, you can also say, because we always want to have a balanced view here, because you might think it's going to go down, but very, very easily it could beat on earnings. So maybe the stock ends up going up to $15. So what happens if the stock goes up to 15 or maybe even 16 instead of going lower? Here, this also allows you at the same time to plan for what is your potential risk, so that you understand how much you're risking before you get into a trade. So if the stock beats earnings instead by May 4th and volatility comes down, here you lose $67 if you had shorted the stock, you lose $76 if you had bought the put, you lose $64 if you had bought this put vertical. So as you can see on these three strategies, this put vertical not only provides you with the smallest amount of loss if you're wrong, but also the highest return if you're right. That's really why this strategy here gives you the higher options play score. A lot of people ask us, what's the options play score? The options play score just tells you how well balanced the risk is to the reward. Meaning, are you getting good risk to reward, or are you getting poor risk to reward? And it tells you out of these three strategies, the vertical gives you the best risk to reward. And as you can see, when we're correct, we're getting some nice returns here on the vertical. And we're wrong, we're actually losing the least amount of money here on the vertical as well. Because when you're buying an option, your risk is limited to what you've paid for it. So here your maximum risk is $1,200. Here your maximum risk is, $112. Your maximum risk here is $100. And your maximum risk here is actually unlimited. If the stock goes to infinity, you will lose a large amount of money if you had shorted the stock. So this is why, if you're trading earnings, generally speaking, buying the stock or shorting the stock is not a good idea, because your risk is extremely high if you just bought or sold the stock. Buying a put or a call limits that risk, but still gives you that unlimited profit potential if it goes in your favor. So let's look at a few other examples here. I've got a lot of mining stocks reporting earnings here. Decay, this is a stock trading at 463. A very low price stock, so may not be the best example here, but as you can see, it's got a technical score of 3. This tells me this is a weak stock that's underperforming the overall market. These are the types of stocks that tend to miss on earnings. The weaker the stock, the poorer the relative strength, the more likely it's going to miss on earnings. Stocks with strong relative strength, or the ones that are outperforming the markets, tend to have a higher probability of beating earnings. But again, I'm not here to say one way or another. I don't have a view on this underlying stock. This is not a recommendation to take a bearish trade on this stock, but I am going to use this as a bearish example here. So the stock's trading at 463. This stock reports earnings on May 8th, about 28 days from now. So let's take a look at this. You can short the stock for costs you $462. Buying a put costs you $51. Buying this put vertical costs you $45. Not a huge amount of difference between these two, but from a percentage standpoint, that's still about a 10% savings between buying the put to a put vertical. As you can see, the stock's trading at 463. What if you think it's going to go down to 425? If you think the stock's going to go to 425, a few days after earnings, so it reports earnings on the 8th, so maybe on the 10th or the 11th, and volatility comes down. So this thing's currently trading at 35 vol, which is pretty high. So let's say it comes down to 35, 33. As you can see here, you don't get the same type of returns that we saw in the previous example, but here, if you had shorted the stock, you make an 8% return. If you bought this put, you make a 46% return. If you bought this put vertical, you make a 63% return. So this is really where you can, if you're new to this, I would, again, suggest that you start with this simple strategy because it's easier to understand. And for those of you that have some experience trading, you want to take a look at this vertical here because it does provide you some additional benefits. You're risking less money and you're potentially making a higher return if you are correct on the trade. So what happens if the stock goes further? What happens if it goes down to $4? So if it goes down to $4, which is about a little about 15% down, you're looking at a 95% return on the put, 104% return on the put vertical. And the great thing about this tool is that you can actually use the slider to get an idea as far as how far does the stock really need to go in order for these two strategies to beat each other. So as you can see, if the stock goes down, the strategy on the right, the put vertical, will always have a higher return. But at some point, that will actually start to shift because this strategy here on the right has limited profit potential. So as you can see, the stock needs to go down to about $3.90 before this put starts to outperform this put vertical. So if you expect the stock to really make a move lower, below $3.90, then it tells you that you should actually trade the put. So not only does it tell you what your expected return is based on your outlook, you can also use this slider to get an idea as far as how far does the stock really need to move before one strategy outperforms another. So as you can see, right around $3.92 is when that shift happens. So then you can ask yourself, do I think the stock's going to go below $3.90? If you do, then you want to trade this put. If you don't, then you want to trade this put vertical. So this really allows you to have a definitive way to say which strategy is best for me and what does the stock need to do in order for me to realize the best profit potential for each one of my strategies. And there's no other tool or option chain that will be able to allow you to do that. And that's really why we produced this platform this way, because we needed it as traders. When we were trading ourselves, using the option chain just wasn't good enough in order to help us determine, should I buy the put or should I buy the put vertical, or should I buy this, a credit spread versus a debit spread. You can do lots of different things with this platform. You can modify this. So if, let's say, you don't want to trade the May expiration, you want to trade a longer dated expiration, or maybe you don't want to trade the $5 strike. Maybe you want to trade the $4 strike. This allows you to modify this and see how the strategies perform based on your modifications, okay? So let's take a look at some more examples here. Let's look at some higher price stocks, which we'll do some modifications on the higher price stocks. Fortis trading at $42. This stock reports earnings on May 1st, 21 days from now. So let's take a look at using Fortis, which is trading at $42. This is another neutral stock. The trends are neutral here. So let's look at a bullish example here for once. You know, this stock is kind of stuck between this 42, 44 range. So what happens if you think the stock's going to beat on earnings, you think it's going to go to 45 or maybe a little higher? Let's see what happens here. So let's say we think the stock's going to go to $45, around about an 8 to 9% move. The few days after earnings, which here is May, let's say May 3rd or May 4th, and volatility comes down to, let's say, maybe 10%. From 15. As you can see here, it's very clear that the stock moves up to 45. Between buying a call, which cost me $99, versus buying a call vertical, which is $82 a contract, this strategy here on the right gives me this strategy here in the middle, the call, gives me that higher return. So I get a 200% return if I bought this call option, the May 18th 42 call, so the May 18th at the money call. If the stock moves about 8 to 9% higher on earnings, I'm gonna make a 200% return on the call, but only 133% return on this call vertical, okay? So this allows me to definitively say, if I think the stock's gonna move about 8 to 9% higher, I should buy this call. I should not be looking at that vertical. The stock really doesn't need to move. So for example, here, around 43.85 is really when this call starts to outperform. So you can ask yourself, do I think the stock's gonna go to 43.85, which is right around this resistance level? It was just there a few days ago. So it's not that crazy for a stock to beat earning and be significantly higher above that. So I would say that if you were quite bullish on this stock and you think it's going to beat on earnings, you're better off trading this call versus this call vertical. So not every single example you're going to see that the call vertical is better. Most examples, or a lot of examples, you find the call vertical will give you the better risk reward and the better trade when you set it up. But like I said, you know, such as this example, that doesn't happen all the time. You just have to put the two side by side. Our P&L simulator will allow you to quickly identify which strategy is best suited for you, and you can always modify this. So if you want to change this, so you can use our strategy constructor. A lot of people ask us, how do you trade credit spreads? How do you trade strangles, butterflies, all that stuff? You can use our strategy constructor. Click on modify, and then you can select other strategies. So if, let's say, you want to look at a credit spread, or if, let's say, you want to look at trading another call or a diagonal or anything, other strategies that you want to take a look at, it's available here. So if you want to take a look at trading a straddle, how does that look? How does trading a May straddle look on earnings? So for example, if you think the stock's going to move up to $45 a few days after earnings, here, if you bought the call, make 199% return. If you bought the straddle, make a 65% return. So this allows, a lot of people like to trade straddles around earnings, but you know, when I put them side by side with buying a call or a put, they rarely seem interesting to me, because if the stock stays, you know, anywhere near the current price, I'm losing a fairly significant amount of money on the straddle. But this tool allows you to put all the stuff side by side and decide what's suitable for you. So if, let's say, you don't want to buy a 42 call, you want to buy an in the money call, you can put those three things side by side and see how they perform. This allows you to remove any doubt from your strategies before you place your trade, because you'll know exactly what your expected return is if you're correct. You'll know exactly what your expected losses are if you're wrong, so that there are no surprises after you get into the trade. And that's really the key to successful trading when you're using options, is making sure you understand both your risks and your returns prior to getting into the trade. This way you can plan accordingly. You don't want to be surprised once you're in the trade. So with that, I will just go to one last example here. TELUS, big Canadian telecommunications company. This reports earnings on May 10th. Stock's currently trading around $45. So I don't have a view on this, so I'm okay trading both either bullish or bearish view on the stock. As you can see, it's just between 46 resistance and 43 support. So regardless of what your views are, so if you're bullish, you might want to take a look at it. call. As you can see, we haven't found any call verticals here. So maybe you might want to just buy a call if you think the stock's going to beat earnings and go to 40, let's say 46.33, I said, 46.33. A few days after earnings, which is the 10th. So let's say you think it's going to happen on the 11th or maybe even Monday, and the volatility comes down. So as you can see here, you get about a 61% return. Not a huge return here if the stock moves a little bit higher. Conversely, if you're bearish on the stock, maybe you think it's going to go down to $43, that support level. A few days after earnings, let's say the 14th, and volatility comes down a little. As you can see here, a little better looking trade, 109% return if you bought the put versus 125% return buying the put vertical. This is all designed to make your analysis of each one of these trades as easy as possible. And if once you decide that there's a trade that you want to place, make sure you hit the trade button. This allows you to understand how to enter this trade into your broker's platform. It's really important that if you're trying to place these trades, that you enter them correctly. So we'll tell you exactly how to enter these orders, the action, the quantity, expiration, strike price, put or call, and including the premium. So we'll give you the current bid ask price, so you can also make sure you understand how to place these orders based on pricing. And lastly, the one thing I want to point out is we have a tool here called the strategy checklist. Some of you that are new may not have seen this before, but the strategy checklist was really designed for those of you that are newer to options to make sure you understood your risks before you place the trade. So it checks for 5 different things. It checks for the trend of the stock, the trend of the market to make sure you're trading with the trend. And it's not that you can't trade against the trend. It's just that if you're doing that, you want to make sure you're aware of that. So we're making sure that you're aware that you're trading either with or against the trend. The options play score is the risk reward metric that I was showing you guys before. Just gives you an idea as far as whether you're trading an option with relatively good risk reward or poor risk reward. We check for earnings date. This is important so that you understand whether there's earnings between expiration or there's earnings before expiration. You can trade earnings. There's nothing wrong with trading earnings. It's just making sure that you're aware of it before you place a trade and that you don't get surprised after you get into a trade and then realize there's earnings before now and expiration. And lastly, we look at the liquidity, the spread between the bid and the ask price. Whether that's large or small tells you how liquid an option is. So we check for all of these things to make sure you understand your risks before you place a trade. And if you accept all of those risks, then you can enter these trades into your brokerage platform as we state here above here. So that's just a quick snapshot of kind of how to use our platform. You type in the symbol that you're interested in, or you can use our trade ideas and watch list if you're looking for some ideas. This tool is designed to give you a quick snapshot of what's currently going on with the underlying stock. So trend indicators, relative strength indicators, support and resistance levels, and all the data that you need along, such as earnings date, dividends date, and current price action, so you can see what's going on with the underlying stock. And then lastly, trading and income. This is designed to help you quickly find strategies that make sense regardless of what your views are on the underlying stock. You can always click on I'm bullish to be presented with some bullish strategies. I'm bearish to be presented with some bearish strategies, and then the P&L simulator so that you can quickly identify which strategy is best suited for you. So with that, that concludes what I wanted to show you guys. So what I'll do is I'll, at this point, open this up for Q&A. If you have any questions regarding anything I spoke about here today, please type into the chat window and I'll answer your questions as they come along. So I have one question here from someone saying, can I use CTC.A as one of my examples? So this is a stock. I don't know if this currently has a reported earnings date, because as I can see here down here, it's got an earnings date of NA. I don't, if you know of an earnings date on this particular stock, let me know, but I don't see one as of right now. April 27th. I believe that's the next dividend date, April 27th. Are you sure that that's the next earnings date as well? So because there's no earnings coming up, but let's assume that it does have earnings on April 27th for 1 second, okay? The stock's trading at 61.70 right now. As you can see, this stock, I believe, if I'm not mistaken, the last earnings date was February 14th, right here. It went from 163 to 170 overnight on earnings. That's probably what causes large gap higher. So I would expect that this thing would report not in April, but in May, mid-May. That would be my expectation. So that's about 90 days out. There isn't a trade here to make per se. I usually don't suggest you to get into an earnings trade this early. You don't want to get into a trade a month and a half out before earnings, because then you get a lot of swings between now and then. If you want to trade earnings, wait till a few weeks before earnings to get into that trade. So on this particular trade, I would actually wait a little. But let's just say it did have earnings on April 27th and that wasn't the dividend date. Then I would consider, taking a look at this trade. So, as you can see, the last time that the stock not only beat earnings, went up by about $7, but look at the follow through the couple of days later. So 1, 2, 3 days later, it was at 178, 180. So even though the initial move went from 163 to 170, it moved another $10 higher over the next 4 days. That's why you want to give yourself that 1 to 2 week buffer after earnings in order to see if the stock continues to move higher. So let's say you think the stock's going to do the same thing. It's going to go back up to 180. Let's presume that the earnings date is 27th. So let's say a few days after earnings, let's say the following Wednesday, the stock moves up to 181 or 180 rather, and volatility comes down a little. As you can see here, buying the call gives you that higher return, 123%, 113% return versus 104% return. So unfortunately, I don't think the stock reports on April 27th. I believe that's the earnings date. I would imagine that the earnings date is more like May 15th based on the last earnings date, but this is how you can use your tool for that. Ken's asking, you talked about delta and such at the start. Where do we see those? So delta is something that you'll see on the option chain. Now, the reason I'm not showing you delta is because unless you plan on doing the math yourself, I don't know why it's not as useful to you, right? So I'll tell you the delta of an option is 50 cents or 40 cents or 30 cents, but then you have to calculate, oh, I think the stock's gonna move up by $12. So then you have to multiply 12 by 50 cents. That'll tell you that you'll expect the call option move by $6. But then I'll teach you that, when you get a large enough move, delta isn't accurate enough because now you have to factor into gamma. Then we start going into rabbit holes about kind of all the different things you need to learn about option pricing to really understand option pricing. And I don't want to go down that rabbit hole. So that's really why I want to focus you guys on just calculating the expected return of a stock based on using our P&L simulator. Because delta just simply tells you if the stock moves up by $1, how much does the option price move by? But we don't think in those terms because we just know that the stock's at 169 right now. We think it's going to go up to 180. So then you don't have to do any of this calculations. It's all calculated for you based on the P&L simulator. We can take the delta, we take the gamma, we take all the different more intricate things that go into your option pricing and already calculated for you exactly. So you just have to know, hey, I think the stock's at 170 right now. I think it's going to go to 180. It takes the delta, calculates it for you, and tells you what the expected profit is and tells you what the expected return is so that you don't have to do any of those calculations on your own. Great question, though. Thanks, Ken. Any other questions regarding the things that I spoke about here today? Like I said, this webinar is recorded. I've gone through a lot of things. I've gone through a lot of examples. I don't necessarily expect, especially if this is your first time, to follow everything that I'm saying. So I will actually send the recording out as soon as I can after this so that you guys can review everything that I'm showing you here today so that you can actually take the time, use it along with your platforms and follow along so that you'll have a much better understanding of how to use everything that I spoke about here today when you watch the recording, when you have the platform in front of you. If you have any other questions, please type them into the chat window. If I don't have any other questions here for today, I just want to thank everyone for taking the time out this afternoon to listen to this webinar. Earnings season that's coming up should be an interesting one because of the new volatility we've been seeing in the markets. Has certainly shake things up a little. I think it's changed the landscape a little, and I hope that earnings season helps shift us back into the mindset of thinking about corporate profits, because that's really what should be driving the equity markets, not what's currently going on in the news. There's a little bit of too much of that, in my opinion. So I certainly think that now that we're heading to earnings season, we're going to be paying a bit more attention back to corporate profits, which is really what we should be focused on. So I hope you guys have found the information that's in this webinar useful in helping you navigate the upcoming earnings season. And like I said, please make sure that you view the recording. If you have any questions, there will be an email in the email with the recording. So please shoot us your questions there if you don't have any of them right now. And again, thanks everyone for joining me this afternoon, and I'll send this recording out to you guys in just about 30 minutes. And I hope you guys all have a great afternoon, and I'll see you guys back here in a few weeks when we do our next webinar. Thanks so much, and I hope everyone has a great afternoon.